Buy, borrow, die versus BRRRR or BRRRR. One is a wealth builder, one is a protector. How's it going, everyone? My name is John Howard. In this short video today, I'm going to talk about this subject of the popular buy, borrow, die. That's actually something that I'm actually doing on my own, but we're going to talk about this very subject. Okay, buy, borrow, die is a powerful strategy people with assets use that combines strategic borrowing with income producing and high ROI assets. We hold these forever. When we need capital, we borrow against the equity tax-free rather than selling. Our assets compound in the background, no capital gains taxes, no sales transaction costs, no resetting the compounding clock. Buy, borrow, die works because we're stacking a approximately 7.5% annual return on the asset. There's a caveat here. The actual return on your equity is much higher. So when I say asset, we're talking about real estate here, right? So let's say you have a $500,000 property. Well, if you put 10% down, your equity is $50,000. So effectively what's happening is, on average, over a long period of time, you're getting about a 4% return on the asset on that $500,000 property, which what that means is it's about 3.5% approximately because of amortization, provided you have a good loan, you're paying it down with 360 payments, and approximately 4% appreciation per year. So those two together are 7.5%. So if you actually, obviously do the math, you're getting a 7.5% return on that asset that you have. If you have multiple properties, it's 7.5% on the actual property value. So if you put 10% down, 5%, 3.5%, which you can do with FHA, or something like 20%. Any way you cut it, it's a much higher return on your equity. And if you do refi cash outs or, ultimately get your equity, your original capital back through equity financing, you then kind of have what people call, infinite returns, right? So that's how we're actually stacking a 7.5% annual return on the asset. And that actually is independent of the other benefits that you get, which are tax advantages, cash flow, and liquidity that few other investment vehicles can match. When we die, our heirs inherit our properties, our assets, of course, with a stepped up basis, erasing decades of appreciation from their tax bill entirely. So here's the other one. Real estate investors also worship BRRRR, BRRRR, which is buy, rehab, rent, refinance, repeat. It's the classic wealth launch and acceleration playbook. Find attractive properties, acquire them, force equity through renovations, rent to maximize cash flow, refinance to pull capital out, and repeat that process. It works. We can build and grow portfolios aggressively and create equity from just the initial capital we use to get into the first property and get that first property launched. What does that mean? Well, that means you get into one property, you get it launched, you get it cash flowing, you get some equity, and then you can take the equity from that first property and then you can go get the second one. Are you going to need some more cash? Maybe, probably. But if you do it right, and then, you do have equity in that first property, you can take that equity and put it into the next property. BRRRR can be a grind though, right? Every refinance means appraisals. Every, it could also be equity financing, a home equity loan, a home equity line of credit, or now the home equity agreements, which I've actually been looking into and trying to get going here, right? We are constantly in acquisition mode, managing rehabs, chasing the next deal. But it is what it is. BRRRR builds the empire. BRRRR is aggressive expansion. Buy, borrow, die is strategic compounding. BRRRR asks, how fast can I build the portfolio? Buy, borrow, die asks, how long do we let this compound? Savvy investors, they do both. BRRRR is the grind, and most do it in their 30s and 40s, maybe even 50s, to build and grow the portfolio. Then it's buy, borrow, die to protect what's been built and let the multiple forces of cash flow, appreciation, amortization, tax-free liquidity, and tax advantages work simultaneously to grow your assets. Long-term generational equity is built by acquiring the right assets once and then never letting them go. BRRRR creates the empire, buy, borrow, die, keeps it tax-free across generations forever, hopefully for multiple generations, right? So everybody, so there you go. There is buy, borrow, die versus BRRRR. I've actually also, in addition to, these videos, I've been doing some social media posting and noticed that buy, borrow, die is getting a lot of traction. People seem to be very inquisitive about the strategy and drawn to it, and commenting and everything. It's kind of funny because it's kind of what I'm doing. In addition to doing this YouTube video, I've actually done short and medium-term furnished rentals for literally the last 2 decades, since 2005. During that time frame, I actually was a rather busy and successful entrepreneur. I launched 4 different businesses that all went up to 7 figures or more each per year, right? And also during that time frame, I owned or managed 5 different short and medium-term furnished rentals. So I say that because it's really something pretty much anybody can do, even a successful executive or whatever. If you're successful in whatever you do, you're a high-income earner, right? And the reality is a high-income earner is going to be the best position to actually get a mortgage, for investment property. You can still do it if you've got bad credit, if you don't really have much money. You just have to get partners, right? And you got to kind of do what you got to do with private money and partners until you can actually get your own going. But I've been doing a lot of real estate content lately because this is my experience, and this is kind of what I've been talking about. Everybody, if you like the idea of real estate investing, what I've done is I have something called the SMTR Launch Kit, which stands for Short and Medium-Term Furnished Rentals. It's a launch kit, very basic, very inexpensive. I actually have it in the links. You can go check out the links and you can go click on it and kind of see what it is. I also have my email address listed. If you are somebody that is already in real estate, or you are interested in getting into it, and you might want to talk to somebody that is a little bit more maybe experienced than you, that's what it's for, right? So you can go and check that out. Also, if you like this video about the differences between BRRRR and buy, borrow, die, you can consider giving the video a like. You could also subscribe to the channel. What I can say is that the whole buy, borrow, die thing, I'm actually still doing. And what's kind of cool about it is that, we have had some pretty, I'm here in Southern California, so it's been some pretty lofty valuations. One of my properties is kind of inland, about an hour and 15 minutes inland. So that property has done well, but if you actually look at it from a 20-year perspective, it's really hasn't gone up that much, at least compared to the coastal communities, because I do have places in the coastal areas. It's really just 2 and then a 3rd partial interest, but the coastal community has gone up more in terms of where it started, where it is. But the inland property, it's just, I think, a little bit of a softer market. But in any case, I'm actually, living the BRRRR. I've got a, business purpose loan on one of them, and, doing various things with it. I'm actually looking at getting a premium STR, now for a different area, maybe the East Coast, trying to figure all that stuff out now. So I'll be actually literally utilizing the equity in my places, to get this next place. And you can do that with HELOCs. HELOCs are a little hard because you have to have the income to qualify for it. And when you have multiple properties, that, isn't always easy, right? But then there's also the refis. You can do refi cash outs. There's also equity loans. And then the last one, which is, relatively new and, fairly appealing for a lot of people, which is the home equity investments, or HEIs, and that's a multitude of companies like Point and HomeTap, and they'll come in and basically make an investment in your home, and you have no monthly payments. It's not cheap money. It's definitely going to cost money to get those, but they're pretty attractive, especially considering one of them, actually a group called Unlock, is they have over 30-year programs. So it's if you think about it, you get your amortization from my places. I've got 2.875 30-year fixed mortgages. You just pay those down over time, and as time goes on, you can just blow those home equity agreements out. Or ideally, you'd blow them out if you don't keep holding on to the properties. So anyway, like I said, everybody, if you want to check that out, if you also maybe know somebody that wants to get into real estate investing and would be interested in short and medium-term furnished rentals, because that's really the way that you can make the most kind of cash on cash return, because as I mentioned, what you're going to see is a 7.5% annual return, 4% is appreciation, and 3.5% is amortization. Other than that, like if you, some of the top hosts are getting about a 20% cash on cash return with premium short-term rentals. So you do that math, I mean, 20 plus 7.5, that's pretty high, you know, 27.5% return. Now, I'm actually not saying that everyone's going to get that, because they might not, but pretty average, you know, hosts out there are seeing 10% cash on cash. So the two combined, 10% plus plus the 7.5, that's pretty compelling. And the reality is there are hosts that are actually doing better than 20%. So if you can do obviously better than 20% cash on cash, that's, you know, pretty good, especially when you add the 7.5% annual return on the asset, which is the appreciation and the amortization. So thank you very much, everybody. Again, if you have any questions, put them in the comments area. Feel free to email me. And